Good evening. My name is Stephen Knapp. I'm the president of George Washington University, and it's a great pleasure to welcome you to this evening's panel discussion of a very timely matter. The title of our conference this evening is Demystifying the Global Financial Crisis, Implications for the World Economy. These last few months have been a very challenging period for the United States, certainly, and also for the world, as we've seen the financial turmoil that continues to dominate the headlines. But it's also an exciting year of transition, of course, here in the nation's capital. And at the George Washington University, we've adopted the theme, America in Transition, to cover a number of events that we're bringing together to focus on important occurrences around the world and to see those in light of the challenges that we're facing the next President of the United States and, of course, other world leaders. And as we were developing the series of events, of course, we could not have anticipated the extent to which events themselves would overtake our interest in transition in the ways that we're seeing played out in the media. Tonight we have an opportunity, though, to gain the kind of perspective that a discussion fostered by a university can provide, a perspective that will enable us to hear the views of a panel of experts on global finance, and we'll have the opportunity to participate in what I'm sure will be a lively discussion of the origins and implications of the current financial crisis. We are actually committed to scholarship and education in the field of international finance, in particular in our School of Business, which organized this event, recently developed a new MBA curriculum dedicated to preparing business leaders with integrity who will focus on the global economy. That program will be officially launched next fall, but it's already been getting some coverage because it really addresses together the issues of ethics and integrity in business leadership and sees those issues in the context of the global economy. The GW Center for International Business Education and Research, or CIBER, was instrumental in designing this evening's program. CIBER, as many of you know, is funded by the U.S. Department of Education, and its mission is to increase the nation's capacity for international understanding and competitiveness. CIBER is a focal point for the business school's international teaching, research, and outreach in the finance field. Tonight's panel includes distinguished speakers, both from within and from outside the GW community, and our moderator for the evening is Robert Weiner, Professor of International Business, Public Policy, and Public Administration and International Affairs at the George Washington University. Professor Weiner holds a Ph.D. in Business Economics from Harvard University as an expert in international finance and strategy. He will introduce our panel, and now please join me in welcoming Professor Weiner and his colleagues. Professor Weiner.
Thank you for those kind words, President Knapp, and welcome to all of you to George Washington University, students, faculty members, alumni, friends, neighbors, anybody who I may have left out. I'm here basically to present a few words from our sponsor, the GW-CIBER. The GW-CIBER's mission under the federal cyber mandate is outreach to the community on international economic issues. And this is a perfect example, and also the teaching and research that goes along with that. That ranges from subjects such as international finance to business languages. We have courses in business Arabic and Russian and all those other countries that have become more important and more of note in the last few years. The cyber network represents about 30 of the top business schools in the United States for the study of international business. GW's International Business Department was ranked 5th by the Financial Times worldwide among all international business departments. And those rankings are based on questionnaires filled out by our own alumni. And in some sense, if our own alumni rate us that highly, that's probably the most important group of people because they're the ones who have the best perspective on what we have given them for their careers. On behalf of the director of cyber, Professor Jennifer Spencer, and the cyber staff, I'm very pleased to introduce a distinguished group of panelists. We have provided their bios, and so I won't go into detail, just to say that we have an exceptionally interesting and exceptionally well-experienced group of people to talk about an event that has left much of the world puzzling. What we've done is decide to have relatively short presentations, and so that will give you a chance to air what's on your mind in terms of questions. I think this is a time of great concern and anxiety in the world, and we hope to do what an academic institution can in terms of understanding the underlying factors that are driving the situation, and also give you a sense of where our experts think we're going. We'll start with Susan Phillips, who you all know as the dean of our school, but who also has a very long, distinguished career in public service and can provide a perspective that the rest of us can't on government actions in the market. And next we'll have Professor John Glaskop, who's formerly the Oliver Carr Endowed Shareholder at George Washington University, and since then has gone on to hold 2 other endowed chairs, and is currently at the University of Cincinnati. He's an expert in real estate. As all of you have been reading the papers and awake for the last few months know, real estate and mortgages have played a role in the current crisis. Third, we'll have Dr. Stein Klaisens, who's well known to researchers in the international finance field for his long and prolific career in path-breaking research in international finance, and who's an expert on international aspects of the financial situation. He's currently Deputy Director of the Research Department, the International Monetary Fund down the street. And then batting cleanup and to fill in any gaps and errors that the rest of us make, we have Russ Ramsey, who is a graduate of GW Business School and head of his own investment firm and chairman of the board of George Washington University. Welcome, and I think we'll start right in with Dean Phillips.
Thanks so very much, Rob, and on behalf of the School of Business, I'm delighted to welcome you here this evening. I'm going to try to set the stage for this evening's discussion, talk a bit about sort of the unfolding of the crisis and then some of the implications of the crisis, and perhaps lay a few questions on the table. I'd like to start out with setting the stage. How did we get to this worldwide financial and economic crisis? And I want to take us back to the decade of the 90s. If you can remember back to the early part of the 1990s, maybe some of you in here can't remember that far back, but some of you can. We were coming out of the recession of 1992, and during that decade, the U.S. economy gained strength. And we were recovering from an S&L crisis. We were coming out of the first Gulf War. Inflation was coming under control. Inflation actually went down from 6% to less than 2% during that decade. Unemployment also declined from over 7% to less than 4%. We had some problems during the 90s and the first part of this century, but it seems that in each case we came out a bit stronger. Think back to Y2K. Many people thought there might be disaster. Well, we got through that. We've also gotten through 9/11. The recession that we had in the first part of the in the early 90s, in the early part of this decade, actually was quite mild following the dot-com crash. It was contained. We had corporate scandals. We did have legislation following that, but compared to the kind of government intervention we're now facing, Sarbanes-Oxley doesn't seem quite so draconian. During that period, there were new programs to encourage home ownership, the Community Reinvestment Act. There were very aggressive goals set by the federal government for home ownership. We had lower interest rates. That also helped, obviously, with home ownership. Some of those lower interest rates reflected lower inflation, but also, I think in retrospect, we now recognize that perhaps some of it was underestimation of risk. At the same time, we had increased productivity. Now, I like to think that business schools are a part of the reason we've had increased productivity, GW specifically, but there was also a lot of investment in technology during this period. There became a sense, I think, as we came into the new decade, that risk was dispersed. We had new kinds of risk management tools that were helping us, such instruments as derivatives, securitization, diverse portfolio diversification, hedging models. There was increased liquidity from all kinds of sources, not only domestically, mutual funds, hedge funds, so on, but also internationally, sovereign funds. Globalization was really taking hold in terms of the financial markets. We were talking about things such as going to international accounting standards, deregulating a lot of our financial regulatory systems that had been put into place over the last 50 or 60 years. Monetary policy. You know, it seemed many people were beginning to believe that monetary policy actually had learned how to operate things. In other words, inflation appeared to be under control, and it seemed as though monetary policy could smooth out some of the bumps in business cycles. The Fed also was intervening fairly regularly whenever there was a financial crisis. 1987, and then we had long-term capital, 9/11, the Asian crisis. This is what is so-called as the Greenspan put. The fact of the matter is, we did come out of that period with very easy money. The beginning part of this decade, it's hard to believe, but we actually had negative real short-term rates from 2002 to 2005. And we actually had 1% Fed funds rates from June 2003 to June 2004. At that time, not so long ago, just 5 years ago, we were concerned about deflation. We weren't as concerned about inflation. Well, things rocked along, seemed pretty good. And then we, starting in about 2006, we started to see some weakening in the housing market. It really got rolling about a year ago, the summer of 2007, with the subprime mortgage market problems. It's as if the subprime problem was a trigger that set off a lot of other consequences throughout the economy. We've ended up with a series of cascading events moving from market to market and different kinds of firms. Well, what went wrong? Clearly, and I think a lot of people have recognized that the incentive structure for mortgage bankers was probably encouraging a lot of people to take on mortgages that perhaps should not have ever been taken out. Securitization. Maybe this was too much of a good thing, and a lot of it wasn't very well done, leaving us with some toxic assets. Credit rating agencies. A lot of these agencies weren't out kicking the tires and looking under the hood. They were giving inflated ratings to many of these securitizations. Bad credit and risk management decisions by some of the world's largest commercial and investment banks got a lot of them into difficulty. You can also argue that our regulatory structure had some holes in it. Well, since the crisis has unwound, there have been a number of policy responses. And I'm going to focus mainly on the United States, because I think some of our other panelists will take up some of the other responses. The major players have been the Federal Reserve, the Treasury, the FDIC, the SEC a little bit, but not quite as much. They focus mainly on the credit agencies and short sale rules and accounting. The Fed, I have to say, has been doing things that I never would have thought they would have been undertaking. Now, first of all, they started out in the summer of 2007, taking up such things as trying to improve mortgage underwriting practices. There have been amendments to several acts in order to implement new kinds of protections. Off-balance sheet. Okay. He's going to keep me on time whether I like it or not. Off-balance sheet entities. A lot of those banks had things off-balance sheets they shouldn't have had off-balance sheet. Or if they were going to have them off-balance sheet, they should have had part of that reserves reflecting the risk of those off-balance sheet entities. The Fed also engaged in significant jawboning to increase capital at banks. Then they started providing liquidity in several different ways. They brought the discount rate down so that it was no longer a penalty rate, making it less expensive and onerous to borrow directly from the Fed. They've set up term facilities, and I'm not going to name off all of them because every day it seems like we're getting a new term facility. But this is direct lending from the Fed, and they have, since they have started, they have expanded the terms, they've expanded the entities that can come and borrow directly from the Fed, and the collateral that's allowed. They're also now buying directly commercial paper, and they're setting up a facility to offer support to money market funds. They've lowered rates. They're now down to 1.5%, and they're meeting this week again. They've also facilitated mergers to try to get sick banks put together with other banks or investment banks in order to try to save some of the entities. Jawboning clearing arrangements. They don't have direct authority for clearing operations, but they have been trying to work behind the scenes to improve clearing. On the fiscal side, Treasury has been in the lead. We had an economic stimulus earlier this year in the spring. Assistance to try to keep people in their homes. There are several different kinds of support here, dealing with the GSE, the government-sponsored enterprises, new strengthened oversight agency for the GSEs, new programs, help for homeowners, loan negotiations being processed by the Federal Housing Administration. Then within the last month or so, we've had the Emergency Economic Stabilization Act, giving Treasury the right to buy troubled assets, provide guarantees, inject capital directly into banks, increase the limits on deposit insurance from $100,000 to $250,000. Then there's the Troubled Asset Relief Program called TARP. And initially, the idea was that Treasury was going to buy troubled assets directly from the banks. Now they're directly injecting capital into banks, and they're getting in return preferred stock. Maybe eventually they'll go back and still try to buy some of these troubled assets. I think they've discovered that if the market can't price them, they're going to have a hard time pricing these troubled assets also. At the same time, the FDIC has stepped forward, now guaranteeing new debt, all new debt issued by banks and other financial institutions. They're also saying that there is unlimited insurance on business deposit accounts used for daily operations, mainly payrolls. They want to make sure that people can continue to have access to funds for meeting payrolls. They're also pressing for refinancing of mortgages. The goal of all of this is to try to unclog the credit markets, to make sure that banks are adequately financed and capitalized to provide basic services. They want to try to restore trust and confidence, reduce gridlock, and bring money that might be sitting on the sidelines back into the investment arena. The hope, of course, is that by investing in banks now, before they go under, they're going to avoid having to rebuild the banking system later. Now, the implications for all of this are that going forward, it's going to be, I think, very hard to avoid a recession. The question at this point is how long and how deep the recession will be. Policy discussions, quite frankly, are just beginning, and there's a lot on the table. You're going to be hearing risk management until it comes out your ears. That's going to be a new byword. Transparency, safety and soundness, which will be more of a mission for investment banks. Clearinghouses for OTC derivatives. The government, the GSEs, Fannie Mae and Freddie Mac, the question is what to do with them. Should they be broken up? Should they be nationalized? They've got a new oversight agency. They're currently in conservatorship. Something's going to happen with the GSEs. Regulatory changes. A lot of things are on the table. Congress is trying to figure out if they should assign it to one committee or if they should set up a new committee. There's talk of merger of the SEC and the CFTC. Banking agencies clearly will come under the microscope. The next area that seems to be of worry is the insurance industry, whether or not we should have a voluntary national charter for insurance companies. Accounting standards, will we really go to the international? Will we start having more government control of accounting as opposed to accounting standards being set in the private sector? Third-party credit rating agencies, clearly there will be some review of those. At this point, a lot of changes have been brought about and a lot more is on the table for discussion. We really need a period of stability, time for housing prices to stabilize, for the credit markets to get unclogged, and so that government can really focus on implementation of all these new programs and not keep coming up with sort of a new set of rules every day. Now, having painted a rather bleak picture, I want to leave you with a few bright spots. There are some things that have worked throughout all of this. Ordinarily, when you have a crisis of this kind of dimension, you would have bank runs. And we have not seen the traditional sort of bank runs. Banks actually have raised capital to strengthen their positions. Over $434 billion of new capital has been raised just this year for banks. Inflation is coming down. Some markets actually worked very well. Futures markets. The stock market remained open and handled huge volumes. In some other countries, stock markets have actually closed because they couldn't handle the activity. Commodity prices are easing. Gasoline. The productivity and entrepreneurial spirit, I think, is going to start exhibiting itself. And, you know, if you think about it, with all the hits the U.S. economy has taken, it's really amazing that it's done as well as it has. There are some signs that credit markets are beginning to move. There is money out there. It's sitting on the sidelines. Right now, what I think we need is some time to heal and de-lever, get rid of some of the leverage in the economy. Traders and investors need to know the rules and have some confidence that those rules aren't going to change every day so that they'll start to get back into the game. Thank you.
Thank you, Susan, for that overview. Rob had told me a couple days ago when he invited me that I had 5 minutes, so I'll try to keep it reasonably close to 5 minutes. Let me first say thank you. It's a great pleasure to be back in the USA this year. As Rob said, when I left George Washington in 2003, I went over to the UK to teach at Cambridge, and we're now back in the USA, and it's sort of fun to come back to GW and see the campus. The business school is a great addition. I think we all have to say thank you to Susan for putting that in place. And I walked through it today, and I've been through Dartmouth's and a lot of the other relatively new program of schools around the country, and GW's is very competitive and very pretty. Let me say as an overview before I give you my 3 key points. The UK and France are going to be hit much harder by this crisis than is the USA, primarily because 9/11 sort of pushed people away from the USA in terms of the finance market, and the investment bankers in the UK took up that slack. and it became a larger proportion of their economy than it is here in the USA. And since it's now collapsed, that's going to put a bigger burden on the UK. So we're sort of lucky we're not the one getting hit the hardest by this. Now, I want to do 3 key points. First, subprime is a serious problem, and it's an important problem, but it did not cause any major investment bank or any major finance company to collapse. So what is the problem? And the problem, in my second point, is its leverage. What happened in the system is people started leveraging these assets in a manner that you could not conceive of. Let's take Bear Stearns just as an example. What Bear Stearns would typically do is they have 30 to 1. That means for every dollar of their equity, they have $29 of debt. Now, I want to remind you there's 2 kinds of leverage in the world. One of them is maybe you have an asset, and let's take subprime as an example. Back in about 2006, subprime would have earned you, if you were holding it in a portfolio in an equity position, it would have earned you about 12 to 15% because these are fairly risky assets. All right? However, if you were Bear Stearns, you could have gone to the marketplace and borrowed money to hold those assets rather than using only your money. And let's say you did it in a sort of typical fashion. Let's say you maybe had 10% equity and you had 90% debt, and you wanted to hold debt roughly equal to the term of the subprime. Subprime's weighted average term structure was about 8 years. That is, on average, people would pay these off or refinance them in about an 8-year period. So if you'd gone out in the marketplace as Bear Stearns and you'd use your general credit, plus if you'd used the debt in the subprime that you're holding as assets, you could have borrowed money for an 8-year term for about 8%. That means now I've got debt of 8%. I've now got this subprime earning me 12. It earned 12 to 15, but let's say we're conservative and we only made the 12. You made a 4% spread. Now that's a lot of money to make for doing this leverage. Now that's one kind of leverage, where you get fixed rate debt that's equal to your fixed rate liability, or the asset in this case. Now, another way to leverage, and you all may remember Orange County out in California, and they were very clever, the manager was. He had a different way to leverage. He then bought basically 8 to 10-year maturity debt, but he financed it by borrowing in the 30 to 90-day market. That is, you borrow very short term, because on average, short-term debt's cheaper than long-term debt. So if you borrow short-term and you lend long, you make the spread. Now, if you're Bear Stearns and you're smart MBA types coming out of Columbia and GW, et cetera, you notice that if I leverage once, I could leverage twice. So instead of financing these subprime mortgages with 8-term fixed-rate debt at about 8%, what they did is finance them with very short-term debt. In fact, 72% of all of the mortgage debt that Bear Stearns invested in was financed in what we in finance call hot money. That is money that's 15-day maturity or under, and much of it was overnight money. That means every night I borrow, and the next day I reborrow. So what they did is basically borrow overnight at 2% or under. It technically depends on which year you look at. So now I'm borrowing at 2%, and I'm making 12. Now, if you're making 12 and you're borrowing at 2 and you pick up 10, some people make very large bonuses. But the problem comes is every day I've got to come back to you for money. Because every night I get your money, I invest it. The next day I come back to you and say, may I do it again? Now, as Susan said, subprime was the trigger. When some of the subprime didn't look so good, and people outside of Bear Stearns looked at Bear and said, you're leveraging these 30 to 1. In fact, some of their SPVs, special purpose vehicles, that we use for legal terms to keep us from going bankrupt if we make a bad bet. That is, we keep them off the books, and only that SPV could go bankrupt. But in some of those, they took one of their dollars of equity. Now remember, they had $1 real and 29 borrowed dollars. But they took one of those magic 30, they called it equity, they put it in an SPV, then they borrowed 10 more dollars. Now that's 300 to 1 leverage, folks. And when you do that right, you make a lot of money. Now the bad news is, though, when there's a hiccup in the economy, and somebody looks at your balance sheet, they won't loan you any more money. Now, Bear Stearns was a solvent firm. There was a run. It wasn't a run on the bank in the sense that Susan talked about, but everybody said one morning, we won't give you any more money. And so then the Fed had to come in and arrange a marriage in order to keep the liquidity operating. Now, that problem of leverage is what's got Lehman in trouble. That problem of leverage is what took down Northern Rock in the UK. Northern Rock was financing mortgages that they were loaning you, which had about an 8 to 10 year maturity in the UK, and they were loaning that money to you based on getting money in the 30 and 90-day commercial paper market. And wait a minute, what happened was, when rates went really high in the short-term market, they were sitting there with long-term debt that they're financing overnight, 30, 90 days, they're in trouble. Now, so the first one was subprime wasn't the real problem. It's a serious problem, and yes, some people made some bad loans, and yes, Congress pushed even Freddie and Fannie to do that to help poor people, and Freddie and Fannie, to their goodness, said no, other people didn't. Third problem, Bear really wanted to make the money. So did Lehman Brothers, so did Northern Rock. You really can't make all the money if you create the securitization, and then you take a fee, and you let somebody else hold it. The way to make the money is keep it on your books, and then you participate. And that's, in fact, what Bear and Lehman and others did, and so did AIG. AIG and their credit swaps were really selling what we call an uncovered put. And a put means if stock prices go down, you can make me pay you what it used to be worth and not what it's worth today. And these credit swap arrangements were really puts, but they were uncovered, except for the general reserves of AIG. There was no direct coverage in the security market. And the way they were written, there really couldn't be. So you've got people essentially leveraging the market, making lots of money in 2001, lots of money in 2002, lots of money in 2003, lots of money, you get the point, until this year. So people have been making a lot of money until the hiccup occurred. And then when the hiccup occurred, you've got a liquidity crisis, and then those dominoes are now falling. So at that point, the only thing I'll say is my very last comment, because that was my 3, is what we need to tell Congress to do, though, is don't over-regulate. If we over-regulate, we won't be competitive against the Chinese, we won't be competitive against the Japanese, the Middle Eastern states, or Singapore, because one of the reasons that Bear Stearns and Lehman Brothers did this, they are in a declining market. We are being displaced in the world, in that market, by the other countries who have more cash. And if you're in a declining industry, like the S&Ls were once before, you do anything desperate to survive, and that's exactly what they were doing. So let's make sure we don't over-regulate because we had a declining industry that took a chance and got caught and failed.
Well, thank you again for inviting me. It's a pleasure to be here. I thought I would talk a little bit about what happens in other countries when we go through these financial crises. I've worked on some crises myself in other parts of the world, Asia, Eastern Europe, and we have actually seen quite a few of these crises. So although it may be surprising to us here in the US and some other advanced countries, we actually have seen around the world about 124 crises since the 1970s. Now, I'm talking about systemic financial crisis. We've seen small crises here, even in the US. The S&L crisis was relatively small. We had it in the 90s. We had some crises in New England when the banking system went down. Of course, we often see banks go down, small banks. Luckily, we have the FDIC intervening, so it doesn't become a systemic crisis, except for this time when we do see that. And I wanted to reflect a little bit on what we learned from those crises, because I think it can tell a little bit of a story, what we can expect in the US, depending on the policy responses. Well, first of all, to tell that these crises that we observed, they can sometimes be very costly. So if you go around the world and see the total fiscal cost, how much money the people had to put on the table from the taxpayer in order to resolve the cost, some of it was recovered, but not all of it. It sometimes went to 50% of GDP. Now that's an extreme case, and I hope we never get there, but if you translate it to a US context, we're talking about $7 trillion or so. So I'm not hoping we will be there, but it can happen. These crises also are very costly on the real economy. Susan already mentioned the recession, I think, is here with us. And when we see these crises, often the recession will be very deeper than normally. So compared to the recession we had with the bust of the internet bubble, I think this one can really be expected to be severe. We've done some work at the IMF comparing these kind of recessions when you have a housing bust or a credit crunch, which we do observe today, of course. They tend to be longer. They last at least a quarter longer compared to the normal 4 quarters. We talk about at least 5 quarters. They also tend to be deeper in terms of the drop in GDP. It's about a percentage point at least more severe. The other fact is that we see these crises come in waves. So we see one now spreading around the world, and it's not finished yet. We've seen this also before. We saw it in the 70s when the crisis hit, when the oil shock came around the world, both advanced countries as well as some developing countries. We saw it in Asia in the 90s when Asia was hit. We saw it then spilling over to other parts. And there's also some other crises in Europe, in the ERM, the currency crisis in the early 90s, that were common to all countries at the same time. Now, what really are the cause of these crises is a study in itself. Susan has mentioned a number of issues, both micro and macro issues. I think we can talk about quite a bit. But it's sometimes interesting how these small crises grow into a bigger one. It's not that the subprime crisis was all that large initially. So when a year ago we were talking in April 2007 about the subprime, we said, well, it's about $300 billion. That's a small fraction of the total US financial system. It's not likely to cause the whole system to go down, simply because it's not large. Now, a year and a half later, we do have to acknowledge that this crisis grow into something larger. So why does that happen? I think in that context, it's very important to take these lessons from these other countries into account, because this is a movie that we have seen before. Although it may be running at a different speed in different countries, and there's some different variations of the movie, nevertheless, there's also some common themes to this movie that we have seen before up close, myself at least. And there's kind of 4 phases of it. The first phase is you try to contain the crisis. And then you move into the restructuring of the banking system. Then you try to fix the assets that are kind of causing the problem. And then you finally exit from the crisis mode. And unfortunately, we're still only in the first of those 4 phases. We're still in the crisis management phase. We're trying to get some macro stability. That's easier in the US because we're starting from a very good base. But in other countries, that typically was a problem with overvalued exchange rates and maybe inflation as well. That's not the problem here. But we do have to provide very macro responses through pumping in more liquidity. As Susan has said, the Fed has really done extraordinary measures there. Its balance sheet has increased enormously. We have to go out to protect the depositors with guarantees. And again, we have gone quite far today in the US in terms of protecting money market funds, in terms of protecting, helping commercial paper and the like, and interbank funding. And then only we have to think of a little bit of the restructuring as well. But we're still in that early phase of trying to contain the crisis. We're not, unfortunately, there yet. And we can just see in the stock market volatility how large that first phase is. Unfortunately, you sometimes can make mistakes. And I will come to that in the very end as well. What are the lessons of how to do it right? Now, the second phase, I think we touched a little bit on it so far, but really haven't got into it, is restructuring of the financial system. Often that means the banking system, but we already see insurance companies and other parts of the system also being exposed. You have to go in, diagnose how large the losses are, and then start providing capital. And often, unfortunately, that capital has to come from the public sector. The government, as it is doing now, is starting to pump in money into the large commercial banks and into the other banks as well. We're talking about $250 billion as part of the Economic Act, Stabilization Act, but I think we're probably going to need more in order to really restructure those banks and put them on a sound footing again. That's a big thing. You have to diagnose the system well, because you don't want to be supporting the ones that are going to be going under anyhow. So there comes in the tricky part. Who do the winners and the losers? And I think the US Treasury at this point is trying to have to face that issue. The third phase is this management of the impaired assets. And I think we shouldn't ignore it, and maybe too little has been done on it so far, because in the end, what is really causing this crisis is an underlying loss somewhere in the system. You can leverage up, you can try the gains for a while, but in the end, if the things come home to roost, you have to recognize who's the losses. And the difficult part is going to be who is going to have to pay the bill for it in the end. So this management of the impaired assets, as we call it in a technical sense, is really about who's going to be paying the losses in the household sector of the depreciated house prices. That means that a lot of people are in negative equity, underwater, and somebody, the banks or the borrower, have to agree on the cost, and the government probably has to step in there as well. The last phase is trying to exit this. Now that's still early days, but if you really start thinking ahead, this is going to be a process that you want to guide already at the beginning, because you have a very large involvement of the government sector, and you don't want to be seeing that as the ultimate goal. You want to also be able to get out of it. So you don't want to overextend yourself as a government, not acquire too many banks or not to take over too many assets. So let me end a little bit about what I've learned from these crises, how you manage it, and I think we can maybe talk about what happens for the US as a consequence. One is important to be comprehensive, really not to start tackling the little bits and pieces, but really try to address the overall crisis all at once. Second, you want to secure the confidence of the depositors. There's nothing worse than having runs at your financial system. Now, we haven't seen bank runs, but we have seen a run at the mutual money market funds. So you need to maintain confidence during this process. As much as possible, you want to talk about losses being recognized, and that's the most politically charged issue, of course, who's going to pay for the bill, but you want to come clean about it as early as possible. You want to bring in new capital. We have seen some capital come in, but we need much more. So the more you can facilitate private funding, the better off you are, of course, and you want to gear your policy interventions as well. Take out the bad institutions. Don't ignore and wait until the final end to take them out. In some sense, the earlier you can take the rotten apples out of it, the better off you are, because they really are the ones that are making the rest of the system much more worse. And lastly, don't ignore the debt restructuring. As I mentioned before, you need to restructure the bad assets, the housing assets. So that's on kind of the responses on the more maybe technical things. Equally important is kind of how do you manage the process. I think that's largely public relations, communications. Important issues here are confront the key questions early on. So if it is a solvency issue, you've got to acknowledge it's a solvency issue. And in this case, we have solvency problems. So liquidity alone, as we have been providing, is not going to give the answer. Communicate that adequately to the public and to the major players. You need public support, and obviously we're in a transition year, so that's a difficult issue, but I think it's a hinder in terms of really getting everybody on board as to what needs to be done. And last two things is plan for uncertainty. There's always going to be this kind of new thing that pops up, and we've seen many of those coming up. And unfortunately also plan for failure. I mean, there are elements in which this is going to go wrong, so having contingency plans in place is very important. I think this is a lessons that apply to the US. I think the big issue at the moment is where do we stop it from spreading, because it is going internationally in a very rapid space. So at the IMF and elsewhere, we've been thinking very hard how we can help some of those countries that are more at the periphery, but nevertheless are being affected by the spillovers, and we can talk about that as well. Thank you.
Good evening. My name is Russ Ramsey, and I am in the hedge fund business, and I think I was asked here this evening to sort of give a little bit of a perspective of what it's sort of like in sort of the real world of the capital markets. And then I'll start off by saying that I think what you've heard here previously is actually extremely thoughtful, and I think it's a great historical perspective as to sort of how we got where we are now and sort of kind of how the path is to sort of move forward. And when I thought about the sort of title of tonight, which is Demystifying the Capital Markets, I thought of a story, and at the risk of not getting anyone to get the right perspective, I'll sort of give you the story of what I think sort of exemplifies much of what happens in the capital markets on an everyday basis. And it's the story of the oil speculator, and Rob here, of course, we all know is an expert in the oil world. And the oil speculator, when he was done with his mission here on Earth, he had made it up to the pearly gates, and he was knocking on the pearly gates and pretty happy he'd been there. And St. Peter comes out and he says, Well, I got news for you, Mr. Oil Speculator. You know, you've checked out pretty good, and, you know, you actually have the qualifications, but I've got some bad news. And the bad news, much like GW here, we've got some tough zoning laws up here in heaven. And over there, see where all the oil speculators are? We're full, okay? And there's nowhere to put you. The oil speculator thought for a second. He said, well, could I just say 4 words? St. Peter said, that's okay. I don't see it. Oil discovered in hell. And all the oil speculators run out of the gate. They run back down. St. Peter sits back and goes, wow, that's pretty creative. He said, well, you know, it's all yours now. There's plenty of room there. And the oil speculator thought for a second. He goes, nah, I want to join him. There might be some truth to that rumor. I give you that because, you know, fill in what you want. You know, futures trader, stock investor, mutual fund manager, individual investor. I mean, to some degree, what happens in the markets gets started with emotion and bad information, not rumor per se, but it gets started with sort of people chasing other people chasing other people's information. At the core, healthy markets, good markets, are based on good information and confidence. And so if you kind of go back to why is today different than September the 6th? Now, things weren't great September the 6th, but September the 6th, all of these financial institutions, Freddie, Fannie, Lehman, Wachovia, Washington Mutual, et cetera, all existed. 98% of the people in this country were paying their mortgages. The world financial markets, defined as only equities, were $20 trillion higher than they were today. So what's different? What's different 6 weeks later? AIG, which all of us probably rely on in some respects, was the world's biggest insurance company, a couple $100 billion market cap. Today it's a ward right down the street here of the federal government. What's changed? Well, to some degree, nothing's changed, because as you heard here earlier, a lot of this buildup of too much debt, which has happened over, well, probably 15 years, all came to a sort of a culmination. And it sort of happened with a speed which we've never seen before. But we know it can happen. I mean, this is volunteer, but put your hand up if anybody in the audience here has had an investment go down in the last 30 days. Okay, and you don't have to keep your hand up, but keep your hand up if anybody was on margin and somebody called and said, we're selling you out. Okay, don't be embarrassed, because that's what's happening in the world, okay? What's happening in the world, to put it in perspective for you, is we've had one giant margin call, where borrowed money, where the owner of the asset, which financed it with that short-term borrowed money, got a big global margin call. And one thing you know for sure when that happens is that clerk sitting in a desk somewhere, probably in Brooklyn, doesn't care except what they're told to do, which is buy in and call in the money. So this sort of giant margin call is sort of what has gotten things going. And so just like that oil speculator, who in some respects jumped looking for the next rumor, this hasn't been based on, you know, rumor or chasing the next big oil well. This has been forced because of way too much leverage, way too much excesses. And as such, the second piece, which is crucial to a healthy capital market, is confidence. Instead of having confidence in society and the system, this emotion and fear that has taken over, which is promulgated on itself with losses and concerns and new data points saying, I didn't know that, I didn't understand, has just sort of fed on itself. And so where do we go from here? Well, I don't have a crystal ball. You know, we can look at lots of historical perspectives, and let me be serious, you know, for a second. This is meaningful. I mean, what has been created over the last 6-8 weeks will not be done with a new president. It won't be done with some good economic news. In fact, the numbers I think will be awful. You're going to see and hear lots more information about corporate profitability on a worldwide basis. I read something over the weekend suggesting that corporate profits could be off 50% on a worldwide basis. The GDP could shrink somewhere between 5% and 7%. Those are very big numbers. But in my judgment, the important thing to realize is that we have an incredibly innovative society. This globalization, which to some degree is why we've been able to grow as a society and make investments and have productivity gains, which have allowed us to have this prosperity, truly prosperity over the last 3 decades, has not gone away overnight. We have a liquidity issue, which basically the world's governments have all come together and have all basically stabilized and made sure that the credit will start flowing again. And so what now needs to happen is people need to start having confidence. Corporations have to have confidence, governments have to have confidence, society has to have confidence that it's going to be okay to get out of bed tomorrow. It's going to be okay to go to work. And so I'd say to you a couple things as investors, and we're all investors because we all work, we're all productive, we're all paying bills, we're all trying to save a little bit. I'd just say a couple things to you that I really believe in. First of all, turn off CNBC. Okay? Okay, it's the People magazine of the financial markets. You'll never make any money watching CNBC, and I'm serious when I say that. 2, work hard, pay your bills, live below your means. Only borrow money if you can pay it back. If you have excess capital, invest it with a plan. And the reason it's important is because the one thing I can tell you right now, when people are, if they're not being forced via margin calls to sell, people who are selling, going to cash, putting on the mattress, they're guaranteed to be losers. We're going to pay taxes, we're going to have inflation. Okay, the real value of capital is going to go down without a return. And trust me, though, that people have felt this way before. They felt this way in the 70s. They felt this way in the 30s. They felt this way to some degree in the 80s and the 90s. It always happens. But if you have a plan and you have staying power, in my judgment, the result as investors will have a fine outcome. And the final thing I'll leave you with is this is not 1929, and the comparisons aren't even really close. But from 1929 to the depths, the stock market went down 90%. We've already gone down basically in the last 6 weeks, give or take, probably 40%. Those are big numbers. However, from 1929 to the depths, through the depths of the Depression, 10 years later, if you didn't panic, if you had a plan, if you dollar cost averaged, over that 10 years, instead of losing 40% of your money, you'd have made 13%. So it's important to have a plan, to stick with it, to not get out over your skis where other people make decisions for you. And in my judgment, you'll end up having a good and fruitful life as an investor.
Let me start by asking the panelists whether any of you would like to respond to anything that anyone else has said, just in terms of responses. All right, let me, since this is Center for International Business Education Research, let me start by asking the globalization question. One difference between the current crisis and previous crises is the world, especially the financial world, is more globalized. And I'd like to ask any of the panelists who want to take a shot at it, whether you think that affects the solution, or whether you think globalization has been helpful or harmful, and what you see the role of globalization, either causes or effects of the crisis is compared to any previous crisis that you'd like to address. Does anybody want to jump in?
Yeah, I think there's a couple of things. First, it made it easier for other countries to copy what we were doing that was dumb. See, what happened in the past is one country would get it really bad wrong, but everybody else either didn't notice or didn't know what they were doing. So when we had the crisis, only that country had the crisis. But in this case, when the USA started playing these leverage games inside of these investment banks or equivalent entities, the UK picked it up very fast. The French picked it up very fast. As you notice, Iceland seemed to pick it up very fast. Everybody saw it very, very quickly, and they mimicked it. So they were leveraging CDOs, collateralized debt obligations, in Europe, where we were leveraging subprime. So first, you now can transmit this faster among the developed countries. Now, the underdeveloped countries didn't do it because they didn't quite see what we're doing, and they didn't have the same access to credit. But I want to point out something second to you that we haven't talked about yet. Look, having this extra liquidity that we've had for about the last 15 years, as Russell said, I would have said the big strong push came in 2001, but I think Russell's right, it did start earlier. Now, when we add up all the bad things that are happening to us right now, we probably need to remember that our real growth rate was higher because we did have better liquidity. And that liquidity probably made not only our system, the UK system, the French system, the German system, and a lot of underdeveloped countries grew faster because we had that liquidity. So as we cry now, when we're paying off these debts, we should remember our assets are larger than they would have been otherwise. So let's be a little bit careful that we could have had all that good times without paying some of the price now. So I don't want to make you think that we could have had those good times as good as they were without this problem, because that liquidity really helped the system work.
Anyone else?
Yeah, I mean, I think what John just said, globalization always has had benefits, but also has had costs, and I think the volatility that's being introduced, that's now being shared around the world, is unfortunately a side effect. Initially, we were hopeful that the kind of decoupling story that was being touted around, where the developed countries were kind of decoupled from the emerging markets, would give us kind of a buffer on the real side. Unfortunately, I think that decoupling is not going to be maintained going forward. So we're going to see the emerging markets and some of the developing countries also suffer. And unfortunately, we're now in this period of a negative spiral where the global economy as a whole is bringing us down. I think where the other complication arises is from the coordination. It just turns out to be much more difficult to coordinate a solution when you talk about sovereign countries. How can we bring everybody together on the same page in terms of solving the problem, just like we have difficulty coordinating other things?
Coordination.
It's very difficult to get everybody on board. Now, we've seen great progress in the last few weeks. If you were here a few weeks ago during the annual meetings, that Friday was one of the worst days in the market. That week was one of the worst days in the market. And that, I think, really woke everybody up and saying, we've got to have a coordinated approach. And as a consequence, some of that happens. But going forward still, that coordination will remain difficult.
Anyone else?
One thing I'd like to add is to note that, you know, obviously countries are in different levels of development, and their financial systems are really quite different. And I do wonder whether too many people are watching CNBC these days. But the notion of having access to different types of capital, in this country we have generally relied on stock markets, debt markets, in addition to the banking system. So our regulatory systems are somewhat different, and I do think that we're seeing some differential effects from one country to another. So it's not going to be, I think, a complete copycat from one country to another, but there is an element of other countries now trying to build stock markets and debt markets, and maybe they will recognize now some of the dangers. You know, any market can probably be abused, and that's something I think that I hope that they are looking at the lessons coming out of some of this crisis, not just some of the good things that have built up, but we have seen incomes rising around the world, and so you can't say that globalization has, as has been said, we've got benefits as well as some costs, and we got to pay the piper for some of that.
Let's turn and take questions from the audience, and have some microphones. So please, let's make sure that everyone can hear your question.
Yes, since we're having this conversation at a university, I wanted to ask if the panel thinks that we need to make any changes in economic theory. George Soros is one investor who has advocated a move from equilibrium theory to reflexivity theory, and also a reconsideration of the philosophy of science. I was just wondering if you're familiar with that argument and if you agree with it.
The sad thing is, once somebody gets lucky and the market makes a lot of money, they then think they know something. And I think George is in that position. Unfortunately, he's not done a good deal since he had his big accidental win. What you have to do is, remember, in finance theory, we try to see if people can do it over and over. And we can't sort of find anybody that can do it over and over. And even if you take Warren Buffett, and if you were in my class here in the Masters of Finance program, I showed you Warren doesn't beat the market. He's leveraged. what he does is he basically buys about a 0.8 beta, then he leverages it up to 1.2. And if you do that, if you do it carefully, over time, you beat the market nominally, but you don't beat the market in real terms. So I'm still looking for that person who does it over and over, and we sort of haven't found that person out there yet.
I'm John Couric, and I went to the Elliott School in 1994. It's great to come back here as an alumnus. My question is for Mr. Ramsey. I'm a financial advisor, and I don't manage risk or returns. I manage strictly relationships, so you're a lot smarter than I am. But my question is predicated on maybe 2 casualties that I've had thus far, where folks were so unnerved that they said, I'm out of here, and they didn't care what they were going to get in certificates of disappointment or certificates of depreciation. They were going to put it under their mattress. As I look back on, I'm a student of the business, so as I look back on March of 2000, biggest inflows into equity mutual funds to history to date, and then September of 2002, biggest inflows into bond funds. We've seen inflows into real estate commodities all at the wrong time. Do you think in hindsight that we're going to look back on October of 2008 and say that was the worst time to put money into short market funds, into bear sort of funds, and knowing that the lemmings are going to jump off the cliff at the wrong time?
Sure. Well, there's a pretty, I believe, well-tested academic theory that sort of 95% of one's return is based on asset allocation, and certainly in endowments, which in a university setting I think is appropriate, have historically in this country been some of the brightest investors there are, and there have been a fair number of literature sort of laying that out. David Swenson from Yale specifically comes to mind as someone that has written about the importance of asset allocation. So to that question, I think that overweighting any one asset category at sort of the peak or the what appears to be the most emotional time is not wise. And certainly, I suspect 6 months ago, most people in this room could not have defined short selling, and now most of you probably can all define naked short selling, because it's been talked about as the reason for the crash. So my sort of, I think my advice there is, in every wreckage there are assets that are being given away, and the credit markets crashed. They are still in a recovery mode. Fixed income securities, investment grade bonds, high yield bonds, levered loans trade at spreads that are the highest in their history. You can get a return on a GE bond, a bad example, but it's an investment grade credit which is 600 basis points over the Treasury rate. That's historic. So my answer would be that this is not the time, I don't think, to buy puts on the market.
Professor Glaskop urged us not to over-regulate. What does the panel think the elements of the proper regulatory response to this should be?
Well, I'll start out on that. I think that there are some errors that were made. I don't think there's any doubt about that. And I think that in particular, the area that I would point to is the incentive structure for the mortgage brokers. Basically, their incentives were to make commissions on mortgages written. And so as that was done, put on the bank's balance sheets, then securitized and moved off. I think that we have a regulatory system in this country that is somewhat fragmented. There's no doubt about that. And so I think we need to, now just putting agencies together isn't necessarily going to be the answer, because if you think about the CFTC and the SEC, for example, they have two very different regulatory philosophies. They have different acts that they administer, and you can't just put them together and expect that magic is going to happen. I think there's going to have to be a fundamental look at what worked and what are the principles that came out of that and what didn't work and what needs to be fixed. So I certainly agree, let's not overregulate, but let's be very careful about going to plug holes. We do actually have a fairly extensive regulatory system in this country. There's no, we've got regulators in a variety of areas, and probably it's a reflection of the complexity of our markets. We have very complicated markets and that serve different purposes, and so we have regulators. But it has been an add-on process since the 1930s, and it's probably really time to take a fundamental look at what's working and what's not working and what needs to be addressed. I'm not, I guess people would say, people like to think in terms of too much regulation, too little regulation. It seems to me what we've got to focus on is getting the right regulation. There are times when you have market failures. You do have situations where, whether we like it or not, people do engage in fraud. I mean, so we have to have regulations in place to take care of those kinds of situations. But I think what we're all hopeful is that we're not going to put in regulations that the bad guys ignore and the good guys, it just raises their costs. And so that's why I want to emphasize that I hope that, and I think at least so far, Congress has not rushed to re-regulate everything. And they are trying to figure out even how to go about such a massive relook at our regulatory system. So I, at this point, hope that we go towards the right regulation as opposed to just adding more stuff.
Well, I think two difficult issues besides the ones that Susan mentioned that are going to have to be debated is where do you stop with regulation? I mean, what is what we call the perimeter of regulation? Do you cover, in the past we didn't cover investment banks as much as we covered commercial banks. Should we now start to cover hedge funds or some other activities? So that perimeter question is a very complicated one. The other thing I think we learned is that how we deal with large systemic, where systemic means connected or very big institutions. We've seen these Bear Stearns, we've seen Lehman go under and actually having many repercussions on the whole system. And we haven't really figured out a good method to deal with these kind of problems. And I think we have to, because the system, although it may shrink in the short run, eventually it will grow again, and then we're going to have financial conglomerates that we cannot tackle at all anymore.
Any response from either investor perspective or real estate?
Well, I think there are some regulations that are needed, and they're fairly straightforward. The problem is we don't want them. I mean, look, the reason we have big firms is they give more political contributions than small firms do. Freddie, in my opinion, ran a big portfolio because it gave them a bigger presence. One of the bigger presence, you could hide the lobbyists that were economists who weren't research economists. And so if you had a big enough portfolio, it was easy to do that. And I've been saying that for 15 years. So, and Congress wanted that because they got donations. So you got to be a little bit careful about saying you want something that you don't want. Now, there are two simple regulations that would go a long ways. And Bob Van Order, who is now a research economist at Michigan, used to be the chief economist at Freddie Mac here across town. And he said here at GW about 7 years ago, we had a program on whether or not Freddie and Fannie might fail. And our conclusion was they could have the problem that they got. And Bob stood up, and he was on the program, and he said he had a solution, and he's been preaching this for 20 years. Anytime you originate a loan, you have to keep a piece of the action. So he wanted every bank or financial institution, he didn't care what they call them, when they had a loan that got sold on to be securitized, they had to keep a piece of the action, and it had to be a piece of the first loss, right? Now, if you put that in, that deals with the problem Susan was talking about, because if you have to eat the first part of the loss, you're going to make sure it's rated correctly, all right? Now, Bob's been saying this for 25 years, but nobody really wanted that because that would have reduced the number of loans, the size of Freddie, the size of Fannie, the size of HUD, the number of appraisers, the number of salespeople, et cetera. All of us didn't want that market reduced. A second one that I think is more general, no publicly related institution or agency should be allowed to sell what's called uncovered puts or uncovered calls. Now, to me, that would be the law. I wouldn't write anything else. I'd let the courts work it out. The courts will work this out. Case law works extremely well in these vague areas of what that means. Now, you'd have to go through some trauma of a few good court cases to work it out, but after that, you will get good case law that will solve that. But again, Congress won't let the courts do it, even though they're really good at that. I'll give you a very simple example of why we don't want this. I just moved back to the UK and bought a new house. Now, I'm very skeptical about the prices in Cincinnati, and so I negotiated very, very hard. But after it's all over, I'm pretty angry at the bank because in the process, I'd said, I want a real appraisal of the property because I want to make sure that I've not misguessed, even though I'm paying less than everybody thinks I should be paying, but I'm pretty sure the market's volatile. Now, when it's all over, I accuse the bank of having a drive-by appraisal. And I think they did a drive-by appraisal. I don't think they did a fair appraisal. I hold an FRIX designation from the British government and was here in the USA, worked for the Appraisal Institute when I was here. I know the sort of 5 golden rules. And one of them is that comparable property normally should be within about 1.5 miles of the property that you're appraising. Well, 3 of the 5 comps were not. I mean, they were on avenues in Cincinnati I would call uncomparable in all circumstances to the property I bought. Now, here's what the bank said. You wanted the property, didn't you? You got the loan, you got the house. What are you bitching about? Right? Now, see, look, A, the bank got the loan, they made their points. B, the selling agent got his commission. The buying agent got her commission. I was using the female in this case. The appraiser got their money. The title company got their money. And their view was, since I was putting down 20%, okay, it's okay, everybody gets their money. So be very careful. A lot of what occurred was because we wanted it to occur, because everybody got a piece of the action.
Quick question. Assuming we do ultimately turn the corner, what would be some of the early warning signs or indicators that we actually have turned the corner? To put it another way, what would you want to see nationally and internationally to suggest that the downturn is not as long or as deep as some might have feared?
I'll take a shot at that. The system that failed really for the first time really ever was the world's credit systems, the credit markets. They seized up, and the banks who rely on each other to have confidence stopped lending to each other, and so LIBOR basically went up through the roof, and the cost of banks funding with each other was unsustainable, and so that is really promulgated this last set of policy initiatives. So I would pay attention to short rates, you know, what's happening in the commercial paper market, what's happening in the funding market for banks, what's happening in the LIBOR. These are all things that you can track in the Wall Street Journal. You know, I'd say obviously just like plumbing has to work when you go home tonight, the plumbing of the world is the financial credit systems. And so that's step one. Step two is then to start paying attention to when you actually see spreads on riskier assets like corporate bonds, high yield bonds start to come down, and you start to see issuance in the marketplace. Because once you see evidence that loans are starting to find their way out into the mainstream, and they're going to find their way in terms of mortgages and residential, et cetera, but in the business world, then I think you're going to start to see signs that activity will go back to some normal level. Having said that, the numbers are going to be awful for, you know, probably the next 4 quarters. Maybe it's 2, maybe it's, you know, 5, but it's going to be, you know, the numbers are just going to be awful, and I don't think you can pay attention to that because, you know, it's baked in, you know, now, given the steep sort of elimination of activity that's happened with the credit contraction.
You know, one thing I would add to that is, you know, you have to recognize that this is a very diverse country, and we think in terms of that, you know, it's one interest rate, but, you know, in fact, we're going to have different parts of the country recovering at different paces and rates, and so it's going to be very messy. And I think looking at some of the signals that Russ just pointed to, look to see, you know, when money starts moving, and we're starting to see We're actually starting to see some of that happen now. We'll start to see deals. You know, when you start to talk about, you know, markets being down, and then you start, if you're talking to a bunch of entrepreneurs, they're looking for opportunities. So when, you know, and that's what people are trying to guess. When is the time? You know, but it's going to be, I think, different in different places. So it's very difficult to sort of say nationally or even internationally, you can look at one signal. And unfortunately, by the time you get to where everybody's looking at one, you know, things are looking pretty good, you're probably at the peak at that point. So, you know, that's why I think investment is a pretty exciting field, because it does take individual analysis and some judgment, and it's obviously risk-taking.
Hi, I have a question on the regulation piece, which was being discussed earlier. There has been talk about capping the like too big to fail banks. So the choices which have floated around is, one is the Europeans who have suggested that especially the big institutions, governments should have some stake in big financial institutions. Two is, I mean, maybe should be a cap on those institutions. That's one part of my question. Second part is, what's the future of structured products? Obviously, they have benefits. That's why they, you know, they originated in the first place. So, thank you.
I'll start on that one. You know, I think you're quite right, this question about what's too big. But, you know, as soon as you try to say, you know, too big to fail, is that a, you know, should the government actually start bailing out firms just because they're large? You know, and then you start to look at these systemic questions. Are there going to be fallout effects if the government starts to take over some of these firms? But we actually have had, if you look at some of very large firms, banking institutions, they have stayed out of trouble. They have diversified enough so that they haven't gotten in as much trouble. So I think we should not only look for some of the mistakes, but look to see what has been done well, and what did those firms do differently than some of the others. I do think that we're, you know, at this point though, we've got this question about too big to fail, and when does the government stop, and when does the government keep pouring money into it. And I think you're going to start to see some, you know, there are going to be some firms that are going to go under. And I think, as Dr. Klaisens said, at this point, you know, you have to let the bad ones go. You have to let the bad apples go. So there's going to be a lot of messiness, I think, as we go forward. And I think it's very difficult just to draw you know, a simple line, yes, too big to fail, or no the other direction. I don't think it's that simple. There's going to have to be a lot of judgment and analysis that's ongoing, but we've still got a lot to learn from this crisis.
Yeah, I mean, look, let's do the structured products first. Structured products work, and they didn't work in this case because the big people didn't use them. Bear Stearns did not hedge their portfolio, and they deliberately didn't do it because they wanted the return. There's 3 or 4 books out there you can read. They'll already tell you this and show you what they did. So you can't say structured products are good. Oh, they didn't work this time. No, structured products work when you use them, okay?
And use them right.
Well, I mean, SPVs are special purpose vehicles, and what you're supposed to do in those, remember, investment banks normally in the old world made money because you helped with certain kinds of transactions. Maybe you issued stock. Or one of the GW students who graduated here when I was teaching, he went with one of the banks and he helped create a market in REIT debt. There was no secondary market in REIT debt. So they created that market. Then they earned fees from people swapping that secondary debt. And they only held enough for inventory purposes. They didn't then invest in REIT debt. They made their fees. But what Bear Stearns did, and to some extent Lehman, they then had this subprime debt and other kinds of instruments like it, CDOs, et cetera. And they were leveraging them up, and they were holding them on their books and making bets. They were not hedged, which is what hedge funds do. They were deliberately doing high leverage rolling of the dice. So they weren't being used at all. So I don't think structured products is the problem here. It was people who made some good management decisions in the years they made money, and then it caught up with them this year, and they've lost money. Let's be careful about size. I think you want to encourage competition. If you encourage competition, you will get generally good outcomes in the marketplace. Now, the Europeans have always wanted control, okay? I mean, they used to sort of own the banks, and then they sort of lost it because the American system looked like it was the right system. And they want to go back to that. I've lived in the UK last 5 years. I've been to Germany about 5 times every year, to France 10 times every year. I taught at INSEAD. The political system there wants to control everything, all right? I mean, to some extent, China, I was there 12 times this year, is more capitalistic than the UK or France or Germany are, all right? And if you don't sort of get that, you need to go live there a while. So I don't think their solution is the right solution, because I don't think governments can think fast enough normally to operate the economy. And if you don't believe that, look how slow they're handling this, all right?
Well, I think too big to fail is a complicated issue, but I think we cannot avoid it. So we have to, just like we have a building codes, and if you start building skyscrapers that are simply not sustainable, because when they fall over, they're going to hit all the other skyscrapers, we're going to have to impose a penalty for some of these kind of behaviors. So to go out there and maybe impose a capital charge or some other insurance premium that increases with how much damage you can do to the rest of the system is something that comes very natural when we talk about other kinds of economic behavior. So if you impose externalities in terms of environment, okay, the polluter pays. So we're going to have to think of these terms, I think, as well.
Structured products are going to be a dirty word for a long time. But I think there's 3 things to think about, and in my judgment, it's part of the whole cleansing of the system. Transparency. The reason we're where we are today is because the opaqueness of the structured finance world, the opaqueness of the credit default swap world, the opaqueness of the markets that most people in this room couldn't pay attention to or understand if they wanted to. But that was the incentives in the system, were to make things so complicated so that nobody can understand them. And that needs to go away. So 1, there has to be transparency. 2, if there's anything that I can say tonight that's important, balance sheets matter. We live in an income statement world. People don't focus on balance sheets. They don't focus on capital. The whole reason the structured product industry is where it is today, in addition to the one-way, naked, long sort of exposure that John's referred to earlier, is because if you go back to the evolution in 1993, 94, when the banking industry was recovering last time, the banking industry in this country had 10 trillion in assets. Well, you know what? Today, the banking industry still has 10 trillion of assets. The structured finance industry has 20 trillion in assets. But the structured finance industry has no capital requirements. There's no capital underpinning these products. And so people say, well, that's okay because we have MBIA and AMBAC and all these other stuff. Well, guess what? They have no capital either. And so when things are unraveling, there's nobody home. And so going forward, there needs to be capital requirements. As soon as there's capital requirements, there's sufficient cushion to withstand the ebbs and flows and cycles, society will be fine. But that's where we are right now.
Hi, my name is Saeed Elbaz, and I'm a part-time MBA student in GW. I have a question related to Russ's comment on the balance sheet. Is the problem exaggerated because of the mark-to-market rule, accounting rule?
That is a extremely good question. You know, I had the opportunity to speak with our assistant dean earlier, and who's an expert in accounting. And you know, you have to understand, I think this complexity is a big reason why we're here. I come from the kind of keep it simple, stupid approach to investing. Things need to be understandable. I need to be able to explain them to my 2-year-old daughter, not my 17-year-old daughter, in order for them to really work. And with mark-to-market accounting, I think it's become a symptomatic of what is really not the issue. It should be, in my judgment, should be really simple. If an asset is held to maturity and term financed, then it is not subject to mark-to-market accounting. It's silly to take an asset if it's invested for 10 years, it's financed for 10 years, and if you have changes in, you know, interest rates or other things which aren't impairment, which aren't a reason for you to think you're not going to have full value, then it shouldn't be, in my opinion, mark-to-market. On the other hand, if it's a trading account, it's something which is short funded, which is what we've talked about tonight, the problem with the society is the world was one big trade. Everybody short-funded, long-dated assets. So in that circumstance, in my opinion, if you have an asset which takes longer to fund, excuse me, you have an asset which is a long-dated asset and it's funded on a short-term basis, absolutely should be marked to market. And I think we should have accounting regulations that allow for the difference that people can understand. If anybody here can understand the financial statements that we get now with all the different FASB, alphabet soup, then you're a whole lot brighter than I am.
Any other responses?
Abraham Abidor, Foggy Bottom resident, formerly with the Foreign Service. Closer to home, what is the expected impact of the ongoing financial crisis and deteriorating economy on the George Washington University from a standpoint of budget, faculty hiring, and student enrollment, and so on? Thank you.
Susan, you want to answer that?
Oh my goodness. Obviously everybody is going to be affected, and I do have to say that universities, I think as a general matter, there are going to be people who are going to be coming to school, and education actually is probably the strongest investment that anybody can make. Some people will come back if they've lost their jobs, use this as a way to transition to something else. But for other people, this is an investment for life. I certainly hope that the investment side of the house, I mean, they're very diversified, but they're gonna be suffering some losses. But at least at this point, our enrollments are strong, and so far applications are holding up. But we, like everybody, are going to be watching to see what's happening. But so far, generally, universities are a place where people can come back and rejuvenate themselves and rebuild. And so, I think some state universities are going to be really feeling some cutbacks, probably before some of the privates, and we're in that category. So, but we all have to watch the bottom line, no doubt about it.
John, do you want to comment on?
Well, I think Susan's point about state universities is the one to worry about. I mean, I think state universities, particularly in Michigan, Nevada, California, Florida, are going to get hurt. I think strong private universities will do better. The real worry, if you're a university employee, I think I'm lucky enough to be old enough that this is probably not an issue. But look, as an aging population and a relatively small amount of young people being born in the USA means there's going to be a fight in a few years. Education will be a declining industry like the IB banks were. You'll have too many universities for the number of students. And the sort of duking it out over that, it's going to be very messy unless we get either more population from natural birth or from immigration. And I think that's a long-run trend that's being faced now in Europe. And in Europe, the central government, it goes back to this question about trying to own part of the banks, the central government's trying to sort of dictate this from the central government level, and it's just not working. I mean, there's all kind of peculiar answers, trying to make every university shrink proportionately. So Cambridge should shrink the same as a local community college, or Imperial in London, which doesn't quite make sense, but that's the kind of answers you get from government. So I think that's the real long-run thing I'd worry about. Short run, I think Susan's right. Private university is going to do pretty well.
Let me just comment specifically on GW. I think, as everybody knows, there was just a Board of Trustees meeting recently, and I'm very happy to sort of share with everyone that while this university is not immune to the challenges that are facing society and the world, the senior administration has provided for a cushion. There's certainly a lot of staying power. I think this place is extremely well run. Certainly there are things that are important to keep moving forward in terms of applications and continuing to make this a very compelling place for students to come. But certainly sitting in the nation's capital in one of the most economically diverse regions that there is, and having a number of programs which continue to grow and take market share, I think the university is very well positioned.
Since it's getting late, let's take a couple more questions before we break.
I have 3 questions. First question goes to Madam Susan Phillips. The Federal Reserve is widely expected to cut key interest rates further this week. So do you think this will better the present financial situation? And the second question will go to Mr. Stein Klaisens. What's your expectation for the G20 summit, which will be held in DC on November the 15th? And my last question will go to Mr. John Glaskop. Since you've mentioned China twice tonight, so how would you evaluate China's role in dealing with this global financial crisis? Thank you.
Well, first of all, with respect to interest rates, as is mentioned, the Fed is meeting again this week, and I think many people are expecting another rate cut. They're already at 1.5%, so they don't have far to go. So, you know, I think most people are expecting maybe a 50 basis point cut. Now, having said that, I think you have to recognize that that is, you know, pretty low in terms of interest rates. It will have some effect. It will affect, I think, for example, the mortgage markets. It will make some refinancing possible. It may provide some ease. It's not as if, though, there's not plenty of liquidity out there. So a 50 basis point cut right now is not going to have the same effect as it might at another time in our business cycle. It's not going to be a panacea. Because, as I say, there is liquidity out there. The question is, do people want to borrow money? Do they have the confidence to be able to start investing again? So I think that even if they do go ahead and cut, it will certainly have some effect, but it's not going to have the same kind of effect as it might in another part of the business cycle.
On the summit, I think it's very good to hold this. Although it was initially conceived as a summit to talk about the new international architecture, I suspect that the short-run agenda will probably dominate the discussion since we're still in the middle of a financial crisis. So getting these heads of states together to talk about and try to come up with some global workable solutions is probably going to dominate. And then they may set out some agenda for future work as to how to reform the system. Obviously, a lot of questions have come up, as we've seen already in this crisis, but I think to expect big solutions, I don't think this summit is going to give us. We'll probably have to see a range of those with follow-up down the road.
Yeah, in terms of China, I mean, the first thing you need to remember is China is an extremely large holder of USA debt. And that debt makes them very concerned about what goes on here. Now, one of the things they've been doing this the last 4 or 5 years, and they started more aggressively about 18 months ago, is diversifying away from the USA debt and away from the USA dollar. One of the reasons the dollar is falling in foreign markets is not just that our productivity isn't keeping up with China, and so we should fall because they're more productive than us. It was also the Chinese, the Japanese, the Taiwanese, the Singaporeans were all deciding that they had too much money in the dollar basket, and that's going to continue. The USA is going to slowly lose its dollar-based currency as being the primary currency unless our productivity turns around. But secondly, though, look, China's growth rate this year is going to be probably 9%. I think it's probably higher. I think China used to flib and tell you it was 20% when it was only 15. I think this year, because the world wants to think they've slowed down, they're telling you 9. I think it's closer to 12 to 15. I just got back from Hubei. That's another one of those 2 million population cities that no one knows where it is. And they've got something like 50 of these, okay? And I'll tell you, Hubei was not slowing down. I mean the manufacturing's there, the housing's there. The one part of the economy that is slowing down is residential housing prices, but that's deliberate. Their Federal Reserve, or their version of it, has been deliberately slowing down the loans starting about 18 months ago to the housing sector because they thought there was a bubble. And so they deliberately sort of burst that bubble. I think what's the big impact of this for China has now become a bigger player because China is strong, it's growing. We hiccuped, that made us a slightly less strong player. So it's actually increased China's position in the world relative to the financial markets.
We have time for one more question.
Yeah, my name is Russell Krieger. I'm an undergraduate senior. I only have one question, so my question deals with the process of securitization. From what I've seen in the media, they seem to label it as like this mysterious process that's caused great detriment to the capital structures of our nation's greatest banks. However, the way I've come to interpret it as is a vehicle for providing originators with direct access to the capital markets. With that being said, it seems to me like it's created this sort of self-reinforcing effect of allowing the originators, mortgage lenders to go out to the capital markets, offload their loans, raise more capital, with which they are able to use to originate even more loans. So my question is whether basically that the process of securitization has provided a platform for economic success or economic failure, in that by being able to offload the risk to multitudes of investors, it has spread it too far.
Also, you want to do that, or you want me to?
Go ahead.
Yeah, okay, look, securitization works. It's like penicillin. It works, all right? And if you study the financial markets, no matter what country you work in, if you have transparency, which is the one trick that Russell pointed out that I think is the right thing, if you have transparency, and if you have players who have something at risk, securitization is like penicillin. It works. Now, let's remember the USA. The reason that these banks bought maybe some bad loans. Now, by the way, overall, most of these loans are very good. There's not that many bad loans out there, all right? So, but they got leveraged, and that leverage is what's sort of killing us. But there was an honest mistake about how many of these bad loans were not bad. If you were in this room 2 years ago, and we were all discussing whether or not subprimes are good or bad, we're talking about them defaulting at about 8%, okay? Well, an 8% default rate in the subprime market's really not bad. I mean, I don't get very upset about it, because if it's making 14% and we're only getting an 8% default rate, and in the default area, we're normally getting 75 to 85% of our collateral back, that is our cash back. So we're only losing 15% of 8%, but we're making 14. That's not a bad world. I mean, you guys can't work those out that fast, but I've worked those numbers out, and I'll take those bets any day of the week. What happened was, and this happened in the tulip crisis, this happened in .com, everybody thought there was a new world. And this new world, real estate was not going to go down in price. These subprime borrowers were taking some chances, but it's okay because California was really going to keep growing really fast. Florida was really going to keep growing really fast. And so we made some honest mistakes about how many we took on the books. Now, if they hadn't been leveraged to 30 to 1, okay, and if Bear Stearns hadn't been running 52% of their whole operation, not just the mortgages, with overnight money. Now, Goldman, as an example, runs about 10%. And our rule of thumb, and Russell can tell me I'm a little off here, but our rule of thumb is about 8 to 12% hot money. If you're a good player, is okay, but you shouldn't get much above that. Bear Stearns ran 52%. See, that's not securitization. That's just that Bear Stearns was probably one of those firms who should not have made it as an IB bank. They really were not bringing new instruments to market. They weren't creating fees. And most of their money was from holding these kind of instruments. They were taking a chance to stay around. And, okay, they're not around anymore.
Okay. I'm sure we could stay here the whole night to testimony to the subject and to our great panelists. I want to, on behalf of CIBER, to thank them and very much for taking their time.